Here's a question from real trading job interviews, and it wrecks almost everyone. A stock trades at exactly $100, and this stock has zero volatility. None. No wiggle, no surprises, ever. Now I offer you a call option, the right to buy that stock 1 year from now for $100. Interest rates sit at 5%. So, what's a fair price for that option? Most people answer instantly. It's worthless. The stock can't move, so the option can't pay. That answer is wrong, and the reason it's wrong is one of the prettiest ideas in finance. First, the object itself. A call option is a contract. It says, 1 year from today, you may buy the stock for a fixed price, $100 in our case. That fixed price is called the strike. You may buy, you don't have to. So if the stock ends the year above the strike, say at 112, you buy at 100, sell at 112, and you pocket 12. If it ends below, you simply walk away with nothing. One line summarizes all of it. The payoff is the stock price minus 100, or 0, whichever is bigger. Now, the tempting logic. Zero volatility means the price never moves. So a year from now, the stock still sits at 100. Buying at 100, something worth 100 earns you nothing. So the option is worth 0. Quick, clean, and wrong. The mistake hides in the very first step. Zero volatility does not mean the price never moves. It means the price never surprises you. Those are two very different things. Compare two ways of parking $100. The bank pays 5%, so a deposit turns into $105 guaranteed. The stock with zero volatility is also a sure thing. Whatever it will be worth next year is already decided today. Say that number is 103. Then, something absurd opens up. Sell the stock short and park the 100 at the bank. A year later, you collect 105, buy the stock back for 103, and keep $2. Free money with zero risk. And if the stock were headed to 107 instead, run the same trick backwards. Borrow at the bank, buy the stock, and again you pocket $2. Real markets erase these free lunches almost instantly, which forces a conclusion. A stock with no risk must grow exactly like the bank account, from 100 to 105. So here is what zero volatility actually looks like. Not a flat line. A ramp. The stock glides from 100 up to 105 with complete certainty. Now look back at the option. It lets you buy, for 100, a stock that will be worth 105. That's a $5 payoff. Not maybe, guaranteed. So the option hands you $5 1 year from now, no matter what. What is that worth today? Not 5. Money you hold today could sit at the bank earning 5%, so a promise of 5 next year is worth slightly less than 5 now. Exactly how much less? $4.76, because that's the amount that grows into 5 at the bank. And that's the answer. The supposedly worthless option is worth $4.76. If that still feels like a sleight of hand, here's the version with no trust required. We'll build the option ourselves, out of ordinary parts. Buy the share. That costs $100. At the same time, borrow $95.24 from the bank. Out of pocket, you've paid $4.76. Now fast forward 1 year. Your share is worth $105, guaranteed. Your debt has grown to exactly $100. Settle it, and you are left holding $5. That is the option's payoff, to the penny, in every possible future. And two things that always pay the same must cost the same. So the options price is pinned at $4.76. The hedge, by the way, is as simple as it gets. Hold one share. There's a bigger lesson hiding in this puzzle. Don't stare at where the stock is. Ask where it is going. The stock's guaranteed destination, what traders call its forward price, is 105. The strike is 100. So the option is a claim on the gap between those two numbers. $5, paid in a year, worth $4.76 now. And the famous Black-Scholes formula says exactly the same thing. Turn its volatility dial down to 0, and the formula collapses. The two probability terms lock onto 1, and all that survives is the stock price minus the discounted strike. 100 minus 95.24. $4.76. The formula knew the answer all along. So why do interviewers keep asking this? Because the wrong answer exposes a reflex. We hear volatility and assume that's where all of an option's value lives. But there are two quieter engines inside every option: time and interest. Switch off all the randomness, and those two keep running. Zero volatility never meant frozen, it meant predictable. And predictable things can still grow. So the next time a problem looks like it's obviously zero, it's worth asking which kind of zero you were handed. Thanks for watching.